Welcome to 20 Minutes of Clarity. I'm your co-host, Jason Noble. And with me today, I have our co-host, Andy Merchant. Thank you so much for being here in person with
Hey,
me.
in person is the best part. I mean, not to mention the fact that one, this is our first time in person, but two, we're celebrating a great launch of your office, your great
Yes.
new office here. So I'm super excited to be here. We're going to meet with a lot of great of your clients later on today. So really excited to be here in person doing 20 Minutes of Clarity
You can tell we're pretty excited for
today.
this. And we're going to be talking about a study that came out from Vanguard. It's Quantifying the Advisor's Alpha is the name of the study. You could look it up. You could find more information when you go through it yourself. But the study says it could be in excess of 3% net of the advisory fee. So 3% is what the advisor's alpha could be if they're doing certain things.
Yeah.
So all of them are not equally weighted, but I will kind of go into some of the key ones, right, Andy, and get your opinion on it. So the first one I kind of want to just dive right into is suitable asset allocation using broadly diversified funds or ETFs. Zero added value. Zero. Why would there be, like, in your opinion, like zero added value?
There's no added value, right? Because people and clients like you listening today are expecting more out of your advisor than just pure investment direction and diversification, right? When we talked earlier, the studies about adding alpha. So for those that don't understand all of our wonderful industry jargon, alpha is the return that your manager, or in our case, your advisor, is providing for your service. Otherwise, just do it yourself,
Yeah.
right? Investment management, even to that study, is showing that a lot of it's becoming such a commodity, or it's commoditizing to where you can get really good diversified portfolios by just investing in yourself. And so advisors or clients are looking at ways that they're looking to their advisor, right, Jason, to help them make really important, timely decisions and have confidence based on a partner or an advisor that has experience in that space.
Yes. Well, so going into asset allocation, which was suitable asset allocation, is what that one segment was talking about. That's just a percentage of your portfolio that's invested in various asset classes, such as stocks, bonds, and cash. And I love what you said. It's becoming a commodity. If you don't know how to build out a comprehensive investment approach by now, you're probably not having a lot of clients, or very many, like not many at all.
Yep.
And you probably should not be doing investment management.
Well, and most of that's also being taken in house, right? I mean, firms like ours have our entire investment management team that's been able to handle that off site. It's different than the traditional past point when advisors used to sell their value add based on the stocks and bonds and the ETFs they would pick and allocation, which is changing because it's being centralized.
Because of the centralization.
Yeah.
Now, one thing I think is clear for everyone that's listening and watching is what can that be versus a concentrated position within your investment profile? Like, how could you get that? Like a company stock, for instance, like it could add value depending on like how the advisor goes about constructing a strategy around that concentrated position or unwinding that concentrated position, which doesn't really go into the study, but that's something that I will say. Like, there's things that I really agreed with, and I really valued the insight that came off the study, and to the point that I even had a really good conversation with one of the people that was working on it, Mr. Benioff. Absolutely phenomenal conversation. And I asked him point blank, how many people out there in the industry are saying, hey, if you hire me, I could add like 3%. And he goes, it's happening more and more. But what bothers me, Jason, is they don't even read the study. They don't even know what adds the most value. They're like, hey, give me your money. Good luck with everything else. And they're not adding any value to the overall client experience. They're just using the study as a baseline for the conversation. So are you okay? Do you want to touch on that, or do you want me to go into what we saw that added the most value?
Yeah, I think we jump right into what adds most value. I mean, our whole point is getting straight to the points in these podcasts and not adding fluff. So let's highlight it.
Behavioral coaching adds up to 200 basis points. In layman's terms, that's 2% of added value is what they were saying.
And in number sense, $1 million portfolio is 20,000.
I like that even better.
Hey, we're getting there.
You were breaking it down.
That's the detail.
Okay, so big part of what we do with clear picture analysis and our clear picture wealth program is around behavioral coaching. But first off, do you agree with up to 2%? And then the second question that I have for you, I got a double question for you.
Double question.
Right?
Okay.
Is how do you use behavioral coaching with your clients
Yep.
to add that value that we're talking about?
So behavioral coaching, right, Jason, we talk in our program, it's mindset.
Mm-hmm.
And mindset meaning we understand within our Clear Picture Wealth program, we understand everybody has a unique background and past experiences. A common example we have is those that borrowed money back in the 80s had higher interest rates. They don't like mortgages, right?
Yeah.
Then we went through this new boom that everybody didn't know what a mortgage above 4% was. And now we're kind of approaching back up. So why mindset is important is that if you go to somebody who may not be buying into mindset around how to leverage money through a mortgage strategy, then what they'll do is they won't make a decision that would have helped them. So really what mindset is about making informed decisions and having confidence in the decision and not waiting. That's where I think you get the 200 basis point additive is because you're confident in what you're doing and you know why you're doing it. And so having a common mindset around strategies is where we're seeing that make up the most in our program.
Where I also will come across behavioral coaching with my clients is where they heard of something through a friend at work or a family member. And what they heard seemed very appealing and attractive to them. But what they were trying to do is like chase the hot stock.
Yep.
Or they heard someone on the on YouTube or something, right? And if you're watching, thank you. But the market's going down and it's the sky is falling, and they felt like they needed to make that adjustment.
Yep.
But when I'm going through is I'm showing them, okay, what if what you're saying comes to fruition? What does that mean? Oh, by the way, like you're still on track to reach your financial goals if that still was to occur with the approach that we're taking, not just with your investments, but then within your financial planning approach.
Mm-hmm.
Then it could be just being transparent and being proactive and doing those what if scenarios.
Yeah.
Right.
Well, we always talk about
but that's behavioral coaching.
Yeah. When we talk about the doors, right? When we go to people for the Clear Picture Wealth program, we're hoping everybody's listening with this study as well, is that we're not here as anything other than our clients' partners. And when I think about partnership, just like much of yours and I, Jason, on deals, is we're here to make decisions together. I'm not selling you on an idea. I'm not asking you to do something that you're not willing to do. Whether we're going to have collaboration on it, but it's going to be based on baseline data, baseline decisions, and understanding mindset is part of behavioral coaching. So we're just trying to see, can we encourage everybody out there, if you want to increase your asset allocation or your performance, you're going to have to do it through just having confidence in making well-informed decisions in a timely manner.
Well, yes. Well, that's what we're here for, is to help them make better informed decisions in a timely manner. So there's another part of the study. We spent a lot of time on that part because it is, according to this study, the most impactful thing that a professional could be doing with their clients. Let's go to asset location up to 60 basis points or 0.6%, right?
Yeah.
Right. Okay. What I'm getting at here is when asset location, can you break that down for me?
Well, asset location to us, right? We'll start with us, and then we'll tell you go to traditional is all about the PPP, right? So we talk all the time, it's about how much you're going to have to public allocation, how much to private, and if you happen to be accredited, then you can get some private investments. That's right. Say the right order. Protection, public, protection, private. Why is that important for those that we're talking to over this? Is that traditionally it's always been about stocks bond mix, your equities to your bonds to your cash, which is great. But what the number one impactful thing that you're going to have to your overall net worth, which is where the study I think is picking up on the added value from advisor decisions, is because of liquidity. Right? Liquidity is the important part of that whole conversation there, because what's going to happen is you're not going to necessarily have a net worth impacted, right, Jason? Because your stocks or bonds move. That's what stocks and bonds do. They don't always go up. They don't always go down. They kind of bounce around. And it's just about timing of when you need the money. When you need money, if you don't have access to the money and liquidity, then you're forced to borrow money at inopportune times. You're forced to sell things at inopportune times. And that's what destroys net worth. So asset location is very important versus asset allocation. And I think is that what studies it.
Yes. So they're saying asset allocation. How much do you have in stocks, bonds, and cash and other investments? Like where, like what percentages you have, nominal value. But you're going to see higher value in asset allocation going. Now they don't talk about our PPPs, but what they're,
Yes.
but what you're jumping
They haven't
into
paid
the.
us for that PPP story
Well,
yet.
no,
So
no, they got to talk to us. They got to call us. Vanguard, I know you're watching and listening. Give us a call. But the thing that I'm going to jump into on the study here was if you have an investment that is in line with your asset allocation, but it has a lot of internal turnover, you would want to put that into like an IRA or a Roth, not into the taxable account where you're going to get those pass through taxes.
yeah, that's strategy allocation.
That's a strategy
Yeah.
allocation,
No.
right? So how much do you put into the Roth? And like, would you put your more aggressive investments into the Roth IRA, or and maybe less aggressive investments into the traditional IRA? Those are the questions and conversations that a qualified financial advisor and professional will be having with you. If they haven't already, then you have to determine, are they really in line with the study? Now, this next one is near and dear to my heart. As a retirement income certified professional, I spent a lot of time on this next one, and they said it could go up to 120 basis points or 1.2% of added value on a proper spending strategy, aka a withdrawal approach.
Mhm.
So I'll talk a lot about it, but I want you to kick us off. When you're working with your clients, what does it look like when you're talking through like a withdrawal strategy or
Yeah.
approach?
Well, and I think it's important to note, there's a lot of reading out there about traditional approaches. And I think the added advisor alpha, which is the conversation today, and Jason's going to go in way much more detail on this, but there's traditional spending, right?
Mhm.
4% of portfolio or this or that, might come out of it. The reality is it's a very complex formula that needs to be considered and based on your original goals. And when I say that, and Jason's going to jump right into this, right? I want you to hit it all. Is it, a lot of things depend on how much of your portfolio are you relying on. And I want you to hit on that a little bit when you talk, because at the end of the
Okay.
day, you need your money to come out of your portfolio. So how do you determine a withdrawal rate? It's not only just a standard rate, it's how much are you going to rely on your portfolio. That's volatility comes into play. And then more importantly, a new study I just read, Jason, was taxes are not being factored in. So your tax rate, I'm throwing you on the spot a little bit, your tax rate and your portfolio reliance are going to determine your thing. So let me summarize that and then I'll let you hit it on.
Yeah.
Is that if you have a high portfolio reliance rate, meaning that you're dependent upon your portfolio, right, to drive most of the income, you can't support maybe a higher withdrawal rate. Now, if that same portfolio to the asset location is highly taxable, an IRA becomes taxable in retirement, in addition to high spending, then that makes your withdrawal rate even lower because you have to pay the government first. So that's how I'm having the conversation. But you're much more the expert in this space. What
Well,
strategy?
this is why we work so well together,
Yeah.
because like we're not far apart on it. And I think just having me talk about withdrawal strategy, to the traditional sense, when you look at a lot of financial plans that come across my desk here in the Charleston area, and I work with clients to now in 28 states. So this is a way for
All
people
different
on.
taxes.
Oh my gosh, at the state level, how do you keep up with
Yeah,
all
yeah.
that? But you better have really good like tax software and
Yeah.
planning software. But what I'm kind of getting into here is when I come across other people's financial plans and withdrawal order, they're taking money from the taxable account first, and then the traditional IRA, and then the Roth. And then other times I'll see like traditional IRA withdrawals, and then the taxable account, and then the Roth at the end of the plan. And it's using I would say old school wisdom on this, where what if you were to take money out of the IRA, a little bit from the brokerage account, the taxable account, like being the joint brokerage account, and then like a little bit from the Roth, especially if you're retired before 65, that could impact your MAGI, your modified adjusted gross income. That could also impact what you pay for your premiums on the Affordable Care Act. So I'll give a quick example. So this couple, they needed $100,000 a year, and the advisor that they were working with had them take all $100,000 out of their 401k, the same 401k that he was not managing.
Wow.
Now the
Fiduciary?
100,000. This was what's that now?
Fiduciary?
No.
It's a whole nother topic.
But yeah, we'll have to talk about that in another meeting. But
Yeah.
so the 100,000 was not 100,000. They had to pull out closer to 120,000 after taxes. Okay, that was just on the federal level. I'm not even talking about the state, and this was New Jersey. Okay, now if I could get their modified adjusted gross income closer to like 65,000, what that was going to do is take $2,300 a month towards their health care down to $300, saving them $2,000 per month on healthcare premiums and get the same exact policies that they already had. The first thing that the client said is, I've been working with my accountant for the last 20 years. Why didn't they bring this to my attention?
Mm-hmm.
And then the second thing he asked is this legal? Okay. And so we called the account, and the account was available. I was shocked. They jumped onto the virtual meeting that we were having. And I said to the account, we're going to do a blended distribution to manage the MAGI for PTC on the ACA. And I started giving him the numbers. Well, he's writing down the numbers feverishly. And he goes, Jason, I think you miscalculated. They will have to pay $200 a month. Now, I already knew that, Andy.
Mm-hmm.
But I gave him an opportunity to save him an extra 100, right? Because he had this brilliant idea. Well, now the client, they became clients because I knew how to do proper spending strategies and withdrawal orders to help them save money on healthcare costs. Everyone that's listening, like, it's all connected. You can't look at this in a myopic viewpoint. It has to be looked at holistically.
Well, it needs to be taken into account early. Too often our industry, I think that this is outside the study, right? But, traditionally people come into our industry expecting that we only work with clients who have assets under management to manage. Our program was designed to strip that away. That's where, the fiduciary conversation that we'll have in another podcast session will come up, right? But we got to start making decisions. So when Jason's talking about, Roth conversions or allocating buckets or taking advantage of the opportunity to do healthcare planning, maybe before you're 65, you can't do that if your only asset is a taxable asset, IRA.
Yeah.
Or 401k, right? And so having that conversation extremely early in life, we're always planning for that transition date of when we don't want to depend on somebody else to pay us.
Yeah.
And so you got to start planning early.
Yeah. I mean, so having the conversations with my clients that are in their 20s, 30s, 40s about the things that we could be doing now to prepare them for when they get into their late 50s and 60s is a very fulfilling conversations because we're coming at it with a plan of attack. It's more than just a financial plan. We're attacking what we're seeing from an economic basis, looking at the 3 Ps, but then also looking at the tax drag that could be incurred if we do the traditional method of just saving in your 401k, maxing out your 401k, and everything else will be fine. No, because what ends up happening is then you're reliant on the full breadth of the market that could be very dynamic and volatile. And you do not want to be betrayed by the market the day you retire. The worst recession, the worst pullback that we ever have in our lives is the first one of the year of retirement, right? So if you have money in different asset pools, buckets, I could call it as well. You got money in the pre-tax, you got money in the Roth, you got money in the after-tax, right? And you have those. Then you have assets that are geared towards, from an accumulation stage, growing, and then to go to the distribution and making it an income producing approach. That's the stuff that they're talking about within the spending strategy.
And my final note, let me throw on, and I know we're probably getting close to our committed time, but there's a graphic I've always seen, right, Jason? It's like when you plan, you go up the mountain, you get to the very top of the mountain, then you have somebody glide you down. That every time I've seen that in every one of our financial conferences, it's like, great. So we're helping our clients build money just to watch them spend it to zero. Having a proper spending strategy, the idea behind it is let's build the mountain up and then let's plateau it. Right. It's so important. And how do you plateau it? Is you avoid the excess distributions from an RMD, required minimum distributions. That's a bucket strategy.
Yes.
You build it out to where you're spending within your limits in the most feasible way. You come up with a protected asset, or your income has to be solved by protected money, and then passive income if you're fortunate to go out there and have more of a high net worth strategy and with those kind of things. But that's retirement independence. is if we can live on enough of our expenses are covered by things we don't have to worry about market volatility, we can seek to plateau.
What you said is resonating with me, Andy, because I don't think we've even talked about this off air. So this is the
Yeah,
first time we're actually having this conversation
in person.
in person, of all things, right? But you're right. There's so much emphasis on helping people get up the mountain. But when we build out the plan, we're looking at the end goal in mind. You got to have the right equipment. You got to have the right tools and resources. So when you get up the mountain, you want to come back down the mountain, or let's say retirement mountain, it's not coming back down to go to zero. No, it's coming back down where you're not working anymore and you're relying on your income streams. But how many people out there are getting the conversations that are helping them think about with the end goal in mind and working backwards to where we are today and looking at all the different factors that come into play? I mean, if
Yeah.
this is resonating with you, I mean, this is where you could reach out so we could have a conversation and introduce you to the Clear Picture Wealth Program. I got to thank Vanguard, even though I don't work with them directly. I got to thank them for coming out with this. They came out with my first time of coming across the study was in 2019, and then they revised it in 2022. Um, why I liked about this so much is I knew that I was adding value through the comments and conversations that I was having with clients and what their financial plans were doing as we were navigating the dynamics of the market and the economy. But then for them to quantify it, so then I could see it. This study for me was validation to the work that we do,
Mhm.
more than
Well,
anything.
it hit on the three main kind of rules that we live by, right? Within the Clear Picture program, just kind of our oath to helping our clients make better, more informed decisions. Is how do you do that? Proper mindset alignment. Proper mindset leads to alignment, and then alignment leads to clarity. And if you're clear and you have a clear path, you're going to make the best, most informed decision possible out there. And we understand that we're a changing environment, so rules always have to do. So that's where a financial expert like Jason and I, or the rest of our advisors at Prime, come into play. Is that we are continually learning, and we work with thousands of clients across the country. Not each of us individually, right? That's the base of the team approach. But we're always learning, and we're always learning there. So we hope to be able to help people make those decisions tomorrow.
And you said it best. Well, this was 22 minutes of clarity. Thank you for tuning in and watching. I'm so excited that you're
Hey,
here.
this is
Thank you
good.
for being here, Andy. So appreciate it.
This is good.
You be well.